All right, ladies and gentlemen, I hope you had a wonderful day. It was a wild day in terms of political rhetoric. We did not end up moving that much, but by the end of the day, one thing was for certain: the Donald Trump trade is back, and a lot of industries are moving around. And now we got to talk about one of the big questions I got today because it relates to what is moving, and that question is now really a good time to start a long term, even though the market is at all-time highs? And my answer, as always, but especially right now, the answer is yes. Today, right here, right now, is actually a very good time. And with everybody talking about what's going on with the elections and politics and really even the rate cuts, everybody is discussing a value rotation, selling out of the big tech names and going into the value names that are trading at the low. People are even bringing this up as part of the Donald Trump trade. They're saying, yeah, the rotation here, the rotation there. And well, once again, you see the same effect of the Russell going higher and all the other indexes kind of meandering and around. Right now, this is one of the best opportunities here. If you are looking to start a long term, the names that have been beaten down, the names that have been clapped by high interest rates, the names that have been overlooked by tech, these are literally the names you want to be buying right now. And if we watch a shift and any of this stuff from Donald Trump to rates kick this off, this may be the last time in the next decade that you will see some of these high quality names that are not trading near their highs. So is now a good time to buy for the long term? If it's not trading at all-time highs in its quality and it's part of this value rotation, then yes, easily, without a doubt. So Chad, we have a lot to talk about. I'm going to go over this. We're going to talk about the Trump trade. I have a bunch of the plays that I made today. I made quite a bit. Then we have plays for tomorrow, the keys, all that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stock Market. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 last. Live in the hills, but still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it down.
But right off the bat, before we get into anything, we got to talk about the Trump trade because it is in full swing. And we were talking yesterday while the market was closed, what is going to happen because of what happened over the weekend with the assassination attempt. Well, you woke up this morning, the bond volatility was real. The biggest loser on the day, or one of the biggest movers, it was the rates going higher. And I think this logic is sus. We talked about it 2 weeks ago, but once again, people are saying, oh yeah, the odds of Donald Trump now is going up. The rates are going to go up. They're now all of a sudden getting worried about spending. Yes, that's why I'm saying it's sus. Why are people freaked out about spending when they didn't already freak out? Are they blaming the taxes? Yeah, Donald Trump will probably do less taxes, but even then, it's not as if the last 4 years, all of the spending you got, it was not accompanied by a bunch of big tax increases. So this idea really boggles my mind, and I really think it's a lot of media and BS surrounding this whole idea. But the fact of the matter is, we saw it last week. Today, people are bringing this narrative once again, and the Trump trade, it brought in higher rates. You had higher healthcare names out of Cigna and Humana. Energy went up a little bit, and the other big winner besides bonds, it was crypto. Literally right after the attack happened, even leading into the futures and market open today, crypto went absolutely insane, and then gold also had another run. But the main thing that we were talking about yesterday, this idea of a reaction based off of what happened, we saw a couple of these trades and industries move, and that's why moving forward for the rest of the week, I definitely think this is going to be something we got to watch for, especially if we notice that bond yields start climbing once again. So that was the first big thing. The second big key, I will say, moving into the next couple of days here, is is we have some events tomorrow. You will be getting the retail sales, and we'll talk about that, but the politics are going to be one of the bigger drivers moving forward. I do think the data could get in the way and distract us a little bit, but in the short run, I think people and investors and politicians, they are all going to try to work out this Trump trade and figure out where equities should lie after all of the probabilities this week start going all over the place. The only other thing I'll say watch out for, we still are in high concentration, meaning on days like today or even like Friday, it may seem obvious why the market is doing something, but I'm sure one day this week we're either going to get a political event or the data like the retail sales or any of the earnings, and then you're going to be left scratching your head like, wait a minute, I thought this happened. How come the market's not doing that? And well, the answer will be the concentration, and don't forget about how much those 7 names can lead everything. So watch out for that. But if I can give you a caution against anything, whether it's Donald Trump, the election odds, and playing this back and forth, a lot of stories can keep happening, but it doesn't really mean anything is changing. Again, the odds of Donald Trump, they're already high about 2 weeks ago. A couple of different things have happened, and maybe the odds are shifting more heavily in his favor, but it's not anything new. Whatever happens with these earnings, unless there's a big blowout or a big miss, none of that is new. The data getting better, Powell even talked about it today, none of that is getting news. So we are still in summer. We have heavy concentration. We're playing this little juggling game with these events. So yeah, it can give you small drivers, but when it's all said and done, a lot of these drivers can fade before the summer does. And don't forget September 1st, end of Labor Day. That's when everything in volatility should return. So watch out for that. That's key number 2. And then finally, coming into the main thing for tomorrow, you have the retail sales. And if it is good data or bad data, very aggressively in either direction, I think that could cause a huge market reaction. However, I think tomorrow is going to be another crash course on concentration, meaning whatever the data does, if there's one big reaction for a major set of the stocks and the overall index only follows 7 of them, you are going to be left scratching your head a couple of times. We'll see what happens after the data. Does the Trump trades, do any of these things that you saw go up today, do they reverse or vice versa? That will be something to watch out for. But other than that, the retail sales will be our only set of data. The question is the consumer still strong or is it weakening? If it's weakening, is it doing so rapidly? Should we be concerned, or is it doing so at a pace where like, yeah, it's weakening, but that means inflation's coming down, soft land, and we're good? And then if it's barely stronger, are people going to feel good? Or if it's really hot, does everybody panic about inflation again? So should be very straightforward. We do got bond auctions and a couple of things moving forward, but I do think it's going to be a mix of juggling the politics now, the concentration, the summertime, and now this data as it relates against the backdrop of September cuts. So Chad, I hope you're ready for all of it. I hope you're locked in, but now let us get into the plays. So, right off the bat, I have a couple of different plays. I think I actually made a few. Yeah, even the first one to start off with, AXP. This is one we brought up yesterday, and, well, they have earnings towards the end of the week, and I decided to make a play on it. I grabbed more than one. I went with the 280 calls for next week, and this one, I do think they could have another good breakout following earnings, and I say another because we hit the last American Express. I think last earnings, we hit 1,000%er there. That one went a little bit crazy, and this 280 play that I made about it, it is above 2 standard deviations, so I think it was a cheap play. I like how a lot of the credit card names and financials have been holding up. The way I'm looking at it, AXP, it's almost a $300 stock. If they could get a back-to-back beat at all-time highs, it should go a little crazy there, but I am not willing to spend a lot of money on it, so watch out for that, though. That was my first play that I made today. Then coming in to play number 2, this one was very interesting. There was news after hours that Disney was caught up in one of those hacks recently. I don't know if it has to do with the AT&T one, but apparently Disney's Slack account got hacked and a lot of info was there, said hacktivists, that's what they called themselves, but Disney was a part of it. There's also some news going on with the ESPN stuff and all of that, but I'm also keeping in mind the Netflix sympathy. Now, here's my problem with this play is that the last couple of months or couple of years, I don't think there's been a good Disney sympathy on Netflix. So maybe we finally get thrown a bone here, but just keep in mind Netflix is this week. Netflix is extremely expensive. Disney has all this news. They've sold off even 20% from their last earnings there. Maybe this is the one that comes back up. I will be keeping my eyes out for it. So watch out for that. That is play number 2. And then finally, play number 3. I don't want to jinx it, man. Maybe I am. Okay, I'm going to jinx it. And it may stop working now that it's on this watch list, but I did tell you about this a couple of watch lists ago. And I was just saying, watch like the end of the day, even the first hour. And I've been doing this. I've been making plays for the first hour, getting in, getting out. And then the last 10 minutes, man, last 5 minutes, I am literally just doing the opposite of whatever the market did. Last 5 minutes, if the market's down, I go long. If the market is up, I go short, and it has paid out very, very well, and that's where all the volume has been. So now that I'm putting it on the watch list, I've literally hit like 5 or 6 of these. Maybe this is going to jinx it and it won't work anymore, but if you do want a definable strategy or something definable, end of the day, you're going to get movement, I would just wait for that last 5-10 minutes, and you should get some volume, especially if there was already a bigger move that preceded whatever you're looking at. So those are the main plays. As far as everything else, I did make a couple of plays today. I grabbed 2 of those AXP 285 calls, or 280. I don't know. Yeah, is that a 85? I don't know. No, 280. Yeah, that's why it shows that. That shouldn't be a parentheses. That's a 0. Yeah, 280 call. I spent $50. If I can make one of them free, I will, and sell out of that. And I went big. I spent $2,000 on an option. I know that's big, but SMCI, I wanted to go early on their earnings. I said, you know what? Screw it. I'll play within one standard deviation here. It's pricing in a lot. This contract covers their earnings. They got added to the NASDAQ 100. If things get excited, maybe there's a pre-run up, or that'll be the hype of the premium, and then it gets killed. I thought I bought it at a discount, but I think the contract even dropped like $500-$600 by the end of the day. So we'll see how that plays out. And then the ES, I had 2 different flips. I shorted it in the morning, made like $100 on it, and then end of the day, I bought one play that went down, and then I averaged on 2 big ones with the last 10 minutes, and literally within a couple of seconds, it went up like $1,700. I had big size, and I was down on it by like $1,000 or $1,200, and then I walked away netting like 490 net on all of the plays for today. So it was a really good day there, but that's all I made. I'm still in my bond plays, as like I talked about from the last couple of days, any of these option plays I've been showing you. And now, oh yeah, we already talked about the question of the day. So now let's get into the economic lesson, baby. Multinational corporations. So we got a lot to talk about, and it does get kind of boring, although this is one of my favorite lessons in understanding multinational corporations. It's going to come up a lot. Even yesterday's lesson, it's just giving you a lot of numbers. Like I said, it reminds me, if you ever read the Bible and they start explaining the instructions to like build the temple and then the 1,500 members of the lineage and all that, you're kind of like, wait a minute. And yeah, that's kind of how this lesson has felt so far. We're going a lot of the growth and understanding stuff, but the point is MNCs are literally responsible for so much that happens in the global economy, and they are incentivized to have an interest in that, and understanding this will help you as we get into the later chapters. So whatever gets bogged down, whatever you think is like, what the hell are we learning here? Remember, it will come up at a later time, and understanding how important and crucial MNCs are. It is, I mean, they are one of the big pillars, and as of nowadays, I mean, they're, you know, what do they say? There's like pillars of government and all that. Well, the MNCs fall nicely into all of that. So keep that in mind, and remember, anytime that I interrupt, that is opinion. But now, economic explanations for multinational corporations. One might wonder why all of the economic transactions that occur between MNC parent firms and their foreign affiliates are not simply handled through the market. Indeed, the prevalence of MNCs in the contemporary international economy is puzzling to neoclassical economists. When the gap or the limited acquire clothes from producers in Bangladesh, they handle most of these transactions through the market. They sign contracts with locally owned Bangladeshi firms that produce clothes and sell them to the retailer. The Gap and the Limited are they talking about Gap? Do not own the firms that produce their clothes. In other instances, however, almost identical transactions are taken out of the market. When Volkswagen decided to assemble some of its cars in Mexico, it could have signed contracts with locally owned Mexican firms, which then could have produced components that met Volkswagen specifications, assembled them into Jettas, Beetles, and Golfs, and sold them into finished cars to Volkswagen. Volkswagen, however, however, didn't opt for this market-based approach, but instead built an assembly plant in Mexico. Volkswagen thus took the economic transactions that would have otherwise taken place between suppliers of components, assemblers, and corporate headquarters out of the market and placed them under sole control of Volkswagen headquarters. The rapid growth of MNC implies that an increasing number of firms have opted to take their international transactions out of the market and to internalize them within a single corporate structure. Why have they done so? In a finding to an answer to this puzzle, we deepen our understanding of how MNCs are something more distinctive than simply large firms. Many MNCs are large, but what truly distinguishes them from other firms is the fact that they organize and manage their international activities very differently than other firms do so. A firm's decision about whether to conduct international transactions through the market or instead to internalize these transactions inside a single corporation reflects some specific characteristics of the economic environment in which it operates. And conceptualizing how these environments shape the firm's decision, the economists have placed the greatest emphasis on the interaction between locational advantages and market imperfections. So we'll get into that, but hopefully that first part is kind of explaining one of the key differences. They're saying, do you leave the business up to the market or do you internalize it? Think like Volkswagen and assembling cars in Mexico. By them creating all of this stuff and facilities and them doing it there in Mexico, they are internalizing it and they're not going to the market even though they're operating in a different country versus saying, okay, we'll assemble these certain parts and then send it back and then we'll let everybody assemble it back in Europe and go from there and let the Mexican market create all the intermediaries. That would be leaving it up to the market. So that's a big distinction here that we're probably going to get into. So continuing, locational advantages. As a first step, we need to understand the factors that encourage a firm to internalize its activities. That is, what factors determine when a firm will stop sourcing all of its inputs and selling all of its outputs at home and begin acquiring its inputs or selling a portion of its outputs in foreign markets. At a very broad level, it's obvious that a firm will internationalize its activities when it believes that it can profit by doing so. Locational advantages derive from specific country characteristics that provide such opportunities. Historically, locational advantages have been based on one of three specific country characteristics: a large reserve of natural resources, a large local market, and opportunities to enhance the efficiency of the firm's operations. A firm based in one country will internationalize its activities in an attempt to profit from one of these characteristics in a foreign country. Locational advantages in a natural resource investment arise from the presence of large deposits of a particular natural resource in a foreign country. The desire to profit from the extraction of these natural resources was perhaps the earliest motivation for international activities. The American copper firms Anaconda and Kennecott, for example, made large direct investments in mining operations in Chile in order to secure supplies for production in the United States. American and European oil companies have invested heavily in the Middle East because countries of that region hold so large a proportion of the world's petroleum reserves. The desire to gain access to natural resources remains important today. Indeed, petroleum and mining together account for 17 of 100 of the largest MNCs currently in operation. Locational advantages for market-oriented investment arise from large consumer markets that are expected to grow rapidly over time. So before we get into that, the first one is saying, obviously, from the beginning of time, what makes people want to go to certain places and focus on those resources in that country? An ample amount of natural resources. The next one is a big market that they can exploit, a large consumer market. So firms looking to sell their products in foreign markets clearly prefer countries with large and growing demand to those with small and stagnant demand. In addition, the degree of industry competition within the host country is important. The less indigenous competition there is in a particular foreign market, the easier it will be for the MNC to sell its products in that market. Finally, the existence of tariff and non-tariff barriers to import is another important consideration for these types of investment. By investing inside the country, firms essentially jump over such barriers to produce and sell in the local market. Countries that have large and fast-growing markets with a relatively small number of indigenous firms in the particular industry and that are sheltered from international competition represent attractive opportunities for the market-oriented MNC investment. Much of the cross-border investment in auto production within the advanced industrialized world fits into this category. During the 1960s, many automotive MNCs made direct investments in the EU to gain access to the emerging common market. During the 80s and 90s, Japanese and German automotive MNCs such as Toyota, Nissan, Honda, BMW, and Mercedes built production facilities in the United States in response to the emergence of voluntary export restraint, VERs, that limited auto imports. Like petroleum and mining, the auto industry is heavily represented among the world's largest MNCs, accounting for 12 of the 100 largest MNCs. Of course, the desire to gain access to foreign markets has not been limited to the auto industry, but has been an important motivation for much FDI in manufacturing as well. Finally, locational advantages and efficiency-oriented investments arise from the availability at lower cost of factors of production that are used intensively in the production of a specific product. In these efficiency-oriented investments, parent firms allocate different stages of the production process to different parts of the world, matching the factor intensity of a production stage to the factor of abundance of particular countries. In computers, electronics, and electrical equipment, for example, the human and physical capital intensive stages of production, such as design and chip fabrication, are performed in the capital-abundant advanced industrialized countries, whereas the more labor-intensive assembly stages of production are performed in labor-abundant developing countries. Locational advantage thus arise from factor endowments. When the contemplated investment is in low-skilled, labor-intensive production, labor-abundant countries have obvious advantage over labor-scarce countries. When the contemplated investment draws heavily upon advanced tech, the availability pool of highly trained scientists is important. American firms in the computer industry, for example, have opted to base many of their overseas activities in East Asian countries where the average skill level is very high, rather than Latin America where on average skill levels are lower. Locational advantages thus provide the economic rationale for a firm's decision to internationalize its activities. These advantages can arise from a country's underlying comparative advantage, as in mineral deposits or abundant labor. They can also be a product or government policies, as in the existence of high tariffs or the creation of reliable economic infrastructure. Whatever the underlying source, locational advantages create a compelling motivation for a firm based in one country to engage in economic transactions with another foreign country. Locational advantages thus help us understand why a firm elects to engage in economic transactions with one country rather than another. For some countries offer potential benefits for cross-border exchanges, whereas others do not. So it's explaining the top 3 reasons, but hopefully in those 3 reasons you're understanding what draws a corporation. How do you go from being an America and making cars or whatever it may be? How do you go about making 15 factories in other countries? And then why do you choose, Japan versus Chile or Mexico over China? What makes you go to some of these places? And it's saying there's 3 little location advantages that drive it, but now there's a little bit more to that, which we're going to continue. Market imperfections. Locational advantages help us understand why some firms opt to internationalize their activities, but they do not help us understand why firms sometimes choose to take the resulting transactions out of the market and place them within a single corporate structure. Why didn't American firms simply buy copper from Chilean firms rather than establish their own mining operations in Chile? Why didn't American computer firms simply buy semiconductors and other components from indigenous East Asian firms rather than create their own chip fab companies in East Asia? Why didn't America auto firms simply export to the EU and Brazil rather than build assembly plants in those countries? To understand why firms sometimes take their transactions out of the market and place them under the control of a single corporate structure, we need to examine the impact of market imperfections. A market imperfection arises when the price mechanism fails to promote a welfare improving transaction. In the global economy, that means under certain conditions, firms will be unable to profit from an existing locational advantage unless they internalize the international transaction. 2 different market imperfections have been used to understand 2 types of internalization: horizontal integration and vertical integration. So if you're not understanding it, they're saying, why do these companies have to go and create a company in one of these countries rather than just buying from those countries? And they're saying, well, because if you end up just buying from them, you're not able to see the same benefit. And why don't you have the same benefit? Because you run into some of these market imperfections and you don't get a overall net gain for what you're doing, even if everybody does promote and work on the same thing. So Continuing, explaining horizontal integration, this occurs when a firm creates multiple production facilities, each of which produces the same good or goods. In the international economy, horizontally integrated MNCs produce the same product in multiple national markets. Auto producers are a good example. Ford, GM, Volkswagen, and the other major Japanese auto producers each produce essentially the same line of cars in factories located in the United States, Western Europe, and Japan. Firms integrating horizontally when a cost advantage is gained by placing a number of plants under common administrative control. Such cost advantages most arise when intangible assets are the most important source of a firm's revenue. An intangible asset is something whose value is derived from the knowledge of or from a set of skills of repertory routines possessed by the firm's team of human and other inputs. An intangible asset can be based on a patented process or design, or it can arise from know-how shared among employees in the firm. Intangible assets often give rise to horizontally integrated firms because those assets are difficult to sell or license to other firms at a price that are accurately reflecting their true value. In other words, markets will fail to promote exchanges between a willing seller of an intangible asset and a willing buyer. The market failure arises because owners of knowledge-based assets confront what has been called the fundamental paradox of information. The value of the information for the purchaser is not known until he has the information, but then he has in effect acquired it without cost. In other words, in order to convey the full value of an intangible asset, the owner must reveal so much of the information which the asset's value is based that the potential purchaser no longer needs to pay to acquire the asset. If the owner is unwilling to reveal that information, potential buyers will be unsure of the asset's true value and will therefore be reluctant to pay for the asset. So he's explaining intangible assets, and I think this is a great lesson, but it's going on to explain why you run into a problem of horizontal integration, how it creates this market inefficiency is because of intangible assets. So he's going to keep explaining. Suppose, for example, that I've developed a production process that reduces by 1/2 the cost of manufacturing cars. This innovation is purely a matter of how the production process is organized and managed and has nothing to do with the machines or tech actually used to produce the cars. I try to sell this knowledge to Ford, but in our negotiations, Ford board of directors is skeptical of my claim that I could cut the firm's cost by 50%. The board members insist that I disclose fully how I will accomplish this before they will even consider purchasing my knowledge, and they want specifics. Once I disclose all the details, however, they will know exactly what changes they need to make in order to realize the cost reductions. As soon as they have this knowledge, they have no reason to pay me to acquire it. Like all the other owners of intangible assets, I will receive less than my asset's true worth when I sell it to another firm. Such market failures create incentives for horizontal integration. Suppose an individual owns an intangible asset that could generate more revenue than is currently being earned because demand for the goods produced with the use of this asset will be greater than can be met from an existing production facility. How can the owner earn additional revenue that the asset will generate? The only way he or she could do this is to create additional production sites. That is, to integrate horizontally and allow each of these facilities to make use of the intangible asset. Because the same firm owns all the production sites, it could realize the full value of the intangible asset without having to try to sell it in an open market. Horizontal integration, therefore, internalizes economic transactions for intangible assets. So do you see why companies choose to internalize instead of go to the market? Why would they go about horizontal integration? Because they may have experience in intangible assets and they can't just go and sell it or work with all these people. If they want to actually make a gain, they are better off horizontally integrating and then just building out throughout the areas they have and then internalizing all of the demand that they're doing for whatever product it is. Wow, fun fact. But continuing, vertical integration refers to instances in which firms internalize their transaction for intermediate goods. An intermediate good is an output of one production process that serves as an input into another production process. Standard Oil, which is dominated by the American oil industry in the late 19th century, is a classic example of vertically integrated firm. Standard Oil owned oil wells, the network through which crude oil was transported from well to refinery, the refineries, and the retail outlets at which the final product was sold. Thus, each stage of production process was contained within a single corporate structure. Why would a single firm incorporate the various stages of production under a single administrative control rather than purchase its inputs from independent producers and sell outputs to other independent firms, either as inputs or additional production or as final goods to independent retailers? factors. To explain this internalization of transactions within a single vertically integrated firm, economists have focused on problems caused by specific assets. A specific asset is an investment that is dedicated to a particular long-term economic relationship. Consider a hypothetical case of a ship owner and a railroad. The ship owner would like to transport the goods he delivers to his dock to market by rail. He contacts the railroad and asks that a rail spur be built from the mainland down to the dock so he could offload goods directly into rail cars. If the railroad agrees to build the spur, then this spur will be dedicated to the transport of that particular ship owner's goods to the main rail line. In other words, the rail spur is an asset that is specific to the ongoing relationship between the ship owner and the railroad owner. Specific assets create incentives for vertical integration because it's difficult to write and enforce long-term contracts. Returning to our example of the ship owner and the railroad, suppose that under the terms of the initial agreement, the ship owner agreed to pay the railroad a certain fee per ton to carry goods to market once the spur was built. This initial fee made is profitable for the railroad to build the spur. Once the spur has been built, however, the ship owner has an incentive to renegotiate the initial contract to achieve a more favorable shipping rate. The ship owner recognizes that because the railroad must incur cost if it decides to reallocate the resources it used to build the spur, the railroad owner will be better off accepting renegotiated terms than refusing to carry the goods. Thus, the existence of a specific asset creates possibilities for opportunistic behavior once the investment has been made. One party in the long-term relationship can take advantage of the specific nature of the asset to extract a larger share of volume from the value from the transaction. The recognition of that asset's specificity creates incentives for opportunistic behavior after the investment has been made, can cause economic actors to refuse to make investments. In our example, the railroad owner will recognize that the ship owner has an incentive to behave opportunistically after the spur is built. Therefore, quite rationally, the railroad owner will refuse to build the spur. As a result, a mutually beneficial transaction between the shipper and railroad will go unrealized. By incorporating the two parties to the transaction within the same ownership structure, vertical integration eliminates the problem arising from specific assets. If the ship owner also owned the railroad, there would be little incentive for opportunistic behavior once the rail spur had been built. And the shipping division of this now vertically integrated firm could pay the firm's railroad division a smaller fee for transporting its goods, but this would simply shift revenues and expenditures between units of the same firm. The firm's overall bottom line would remain constant. By internalizing transactions involving specific assets, therefore, vertical integration enables welfare-improving investments that would not otherwise be made. Firms thus internalize their transactions, take them out of the market, and place them under the control of a single corporate structure in response to market imperfections. When firms earn a substantial share of the revenues from intangible assets, they face strong incentives to integrate horizontal, that is, to create multiple production facilities, all controlled by a single corporate headquarters. When firms earn a substantial share of their revenue from specific assets, they face strong incentives to integrate vertically, that is, to place all of their various stages of production under the control of a single corporate structure. In both cases, incentives to take transactions out of the market and place them within a single corporate structure arise from the inability of the market to accurately price the value of the asset that generates the firm's income. So, there's a couple more. We're going to talk about it here in a little bit, but hopefully you're getting it so far. Is it that these MNCs, think about how we got here. It's actually quite logical. It's not because they're all greedy and want to take over the world, but with how business has operated as they've grown and over the time when they're looking at, okay, hey, we're operating business, all these different countries. Should we leave it up to the market or should we just control it all? Really, the way they're trying to explain it here is that MNCs are a result of market inefficiencies, and that's what has pretty much led to their proliferation. So we'll see as we move forward. But Chatadonia, that is your watch list, ladies and gentlemen. Make sure you're healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, good, bad, the ugly, it don't matter. You always got a need. If you have a need, you'll get better. If you know your need, you'll know where to work. If you think you don't have a need, you're never going to work on improving. Oh, yeah, baby. So let's go, Chatadonia. I love you. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the morning. And on.